Thanks so much for tuning into BQ Conversations. I'm Neeraj Shah, and our guest today, uh, well, if you've been watching BQ Prime regularly, needs no introduction. He somewhere around late 2021, if I'm not wrong, and Manish, I might get these dates wrong a bit here and there, but Manish spoke about the upcoming or impending economic stress. He spoke about uh, a bunch of macros turning around. He also dwelt a bit on the micros and went underweight, at least mid caps and small caps, and by and large equities as well, almost at the right time. So therefore, he got that cycle completely correct. At least I think so. The questions today are where does he believe in the cycle across various asset classes and across economic cycles that we are at currently? What are the trigger points for these to change? And what is he looking out for in the current landscape? Manish, great having you. Thanks for joining in.
Always pleasure talking to you, Neeraj.
So, Manish, I know you look at a bunch of signposts in order to form your opinion. What is it that you're looking at currently? What is it that they are telling you? Can we start off, for example, inflation and the bonds and yields, both global and local?
So Neeraj, if I were to review past year, I think what surprised markets, because to sort of tell of the future, we must know as to what in aggregate market got wrong. And so what surprised markets was persistent inflation in developed markets, more persistent than what they thought it would be. Somewhat inelastic crude to the developing economic stress, and unusually hawkish central bankers. So even the ones who actually got the inflation right, Neeraj, got these central bankers, particularly of the Fed, but also of the ECB reaction function wrong, that they would turn out to be as hawkish to tame inflation. And of course, on the positive side, purely for equity markets, one would wonder, how many people got the corporate earning momentum right, and since it turned out to be very, very strong. So these are the surprises for investors or markets in aggregate over the last 1 year. From market signpost standpoint, Neeraj, I think I would watch for an earnings slowdown, if not an outright recession, driven by sluggishness in macroeconomy and high and persistently high energy prices. Second thing that I would watch, Neeraj, is in my prior, there'll be an absence of central bank put or for Fed put or RBI put, as well as energy put. In a sense, typically when economy is slow, Fed and many other central bankers turn around and actually re-stimulate. I think, markets would be surprised how intolerant or rather tolerant central bankers become for a weakish economy just to tame inflation. But more importantly, I think, markets would be surprised that the energy put that the crude will actually not fall, even though, some of the economies, flirt with recession. So that's from a market point of view. 1 minute on a macro side, I think, markets are beginning to price, particularly bond markets are pricing a US recession, a high probability of that. I think they are exaggerating the impact of what we've seen in the goods slowdown right now. So I'm not baking in a US recession, but if it does happen, it's going to be good for markets, and I can argue for this. And I think while the inflation would be lower, Neeraj, you would be surprised that even a year out, the floor of inflation for developed market would become 2.5% instead of that becoming a cap because of a variety of reasons that we can discuss. So these are the sort of big flashpoints that you need to be watched for. These are my priors, and if they turn out to be sort of different, then I have to change whatever view that I lay out for you.
Sure. Okay. A cross question there before I move on to something else, and actually a few follow-ups there. One, I heard you mention that the central bankers would be a lot more tolerant of a weak economy in order to rein in inflation. And at the same time, I heard you say that a recession might actually be good for markets. Why do you say that?
So central banker tolerance actually is the experience of the past, that in 70s, of course, in US and some other countries, of course, they caved in to rather weak economic growth, only to realize that inflation journey came back very quickly, So that's a documented financial history. And I think, especially US has this, great stuff of actually learning from past. And I don't think they're going to make that mistake. Inflation, of course, has run too hot for too long. So to that extent, I think they would want it secure below 2 before they sort of pivot. So that's my case on CBs, both Europe and more specifically in US, I think not caving in. It's a good case for India, because India is actually being dragged in for no particular reasons. We have a decent macro, growth, inflation is fine. Our central bank actually, this current setup is far more tolerant of inflation, and frankly, until 2024 election cycle kicks in, it won't matter. So if US actually slows down, rather Fed actually folds, it's this dollar wrecking ball which is underway for a while, will stop, and it will stop forcing us to do things, which we don't have to do, for our economy. And therefore, I think local markets, will actually would rejoice, So from a market point of view, in emerging market, and more specifically, given that we are discussing India, it could be a rather good case, I would say, that US, gets into a mildish recession.
Okay.
I'm saying that, it won't happen,
Oh, okay. You're saying it won't happen. Okay, which is, but then just a market follow up there, and then we'll get to inflation and the other dynamics as well. I was reading a Bank of America note this morning, which highlighted how since 1973, 7 instances of past US recessions, Asian markets ex-Japan have fallen 50% on average during these periods.
Yeah.
So if we do hit a recession, you are not saying it will, but if it does happen, then there is still some pain to go for equity markets in Asia, going by history.
Absolutely. So cyclically, I wonder, how at 1/4 of the world economy slipped into recession in a tiny economy such as ours, avoid any backlash.
Yeah.
It's just that, if US persist with tight financial conditions, it could become a balance sheet event for many emerging markets. What you see in Sri Lanka and Pakistan is just a step or two away from even rather robust economies such as China and India. So you have a hawkish policy surprises, which is not my base case, but if they do over next 1 year, we pretty much have a GFC-like setup originating in India and many such EMs. So I'm saying I say that a recession is a mild good case for us, because the alternate actually is pretty bad. If it's 1980s, or 90s, we pretty much end up, in an Asian financial crisis of sorts, which for emerging market turned out to be significantly worse than the GFC. GFC is a mild event for India, if you recall.
Yeah.
But if you were living in Thailand and Indonesia or Malaysia,
in 97,
a generation, couldn't recover from the losses of Asian financial crisis. So I wonder if, that is what is going to unfold for us. But I think and I hope it won't, which is why recession is good.
So India kind of relatively did better back then too, about 25 years ago, Maneesh. My question about whether the relatively better macros, as you alluded to, and the forex reserves, so on and so forth, do help India weather a slightly more difficult macro scenario slightly better, or you don't think so?
We do to a certain extent, but late 90s we were far too small. We were less financialized. Of course, relatively less debt. Private sector debt, especially in household, was pretty much non-existent. And so to that extent, basically, if you live in a forest, whatever happens to US, it makes no difference to you. So I'm not saying that, of course, we were a forest. We were a rather tiny and unconnected of sorts, disconnected economy, and miracle economies of Asia. I'm not saying that today also, our external debt is reasonable. We have a fair amount of reserves. We've learned a lot from, Asian crisis, and to that extent, our macro is rather robust. So I'm not thinking that, that is a base case, since you're forcing me to think of that, we're discussing it, but But I think we will still do well. We are significantly better than the 2013 setup. So of the fragile kins that we became part of, I don't think that's out there for us unless crude sort of hits $150, $160. Then all bets are off for India.
That's true. Yeah. Well, one hopes it doesn't happen that way, Maneesh, but you never know. By the way, where are you on that argument of, because you dwell on geopolitics also quite a bit, where are you on that argument of what could happen to crude? And the big elephant in the room, where are you on the rupee as we stay at 80? Because that's the big story in town.
So on crude, actually, you may have a little bit of a cyclical weakness for now, given how positions are placed. But structurally, for a variety of reasons that we've sort of dwelled upon many times, largely to do with climate change and years of underinvestments, I think that whole of decade, we're going to struggle with higher crude. So it's going to be more like 2005 to 14 rerun for us, and to that extent it's going to be a big rent that we'll be paying to the rest of the world because of consistently high crude. So that's my view on crude. We can sort of discuss in detail if you wish, but coming back to sort of more currency setup, I think it's important to recognize that tight dollar is essentially a policy tool, one to sort of address the cyclical weakness of US, which is inflation, but also a geopolitical tool to crush emerging markets at large, but more specifically China. So I think, when it's easy to actually crush by as I say, this sort of a strong dollar actually is pretty much a poison for emerging market, and we will sort of cough out far too much of growth simply to ensure that the commodity complex fall off. US's hope is that pretty much entire commodity complex falls off, but my bet is that my hope that even crude falls off, but my bet is that it won't. Now on USD INR, my sense is that sort of because of now very high CAD, and it's unlikely that even though there is some pareback on crude right now, we've passed the point, Neeraj, where we will not have to do take macro-prudential measures to actually tame local demand, because 3.5% or perhaps even 4%, given my crude view of current account deficit, is unacceptable in a setup where the financial conditions are too tight, Neeraj. So my sense is that my bet for last 6 months that of since October is short INR and long dollar that persist, and I think that's the only hard currency in the world. I'm actually making a more nuanced point, and you will actually see me making lots of nuanced points, versus what I told you in monsoon of last year, where I argued for underweight equity, and then winter when I argued of creating a lot of cash. I think there are both sides of arguments today. So it's not an outright sort of short INR anymore, but yeah, I think for a structural reasons, it sort of makes sense that a significant proportion of your balance sheet could be in dollar.
So whatever pullbacks happen, because you're being a bit nuanced and either outcomes are possible, are you saying that the flip argument or the flip move may happen because of technical pullback reasons, or could there be fundamental reasons why maybe the rupee starts appreciating or the other currencies also appreciate vis-a-vis the dollar? Since you're saying that either outcome.
Yeah, there is a fundamental construct to it, of course, because I think that, there is at least a narrative which is likely to build that the inflation in developed countries, more specifically in US, may have perhaps cyclically peaked. Okay, so to that extent, the rollover of goods inflation there, and to a certain extent, what's happening in housing market in US, could mean that we center in a soft patch, and that means that Fed backs off a bit, which is then construed as if they're pivoting to soft policies. There also I'm arguing that they are not likely to do it.
Yeah.
What you're likely to meet is 6 months out, maybe a further tighter crude, and therefore elevated inflationary expectations in US as well as pretty much across the world. And to that extent, you would be surprised, as I said in the beginning, that central bankers would persist with rather tight policies and would not pivot. That's likely surprise for market for the doves, because arguments of the dove is this only, right? That we've had the worst time, and let's have the good times ahead. that may not happen. So there is a sort of a fundamental setup, along with, of course, positioning, how much sort of currencies have bled now, especially developed market currencies, yen in Europe particularly. It's likely that a little bit of a breathing moment ahead for them.
Okay, just one small argument on the currency, Maneesh, before we move on to other subjects. So there is this, well, it's not a very large piece of world trade, but there are these alternative payments being arranged across, right, by various bilateral moves that countries are signing, which don't involve the dollar. Does that at any point of time start impacting the USD strength? Other things remaining constant?
Dollar is elephant, and I mean, we don't have time, but there are ideas such as dollar milkshake theory and stuff like that. But essentially, it's too big, okay, and it will fade eventually. But before that, it will actually troll all economies, especially the emerging market. Remember that there's about $35 trillion worth of debt denominated in dollar today, and if dollar is tightening for the local regions of US, okay, if I had borrowed money in India, okay, though I borrowed in INR, but essentially it was dollar denominated, I have to repay in dollar. So I'm actually looking for it, and there are signs in the market, that there is a lot of funding stress. You would be surprised that the 3-month, 6-month T-bills in US are actually trading significantly below the funding rate or OIS curve or swap curve, or if your investors are aware of it, something which Fed policies are expected to deliver. Even if you stay overnight for next 6 months, the treasury bills in US are actually earning you less than that. That's already telling you there is a collateral shortage. Why is there a collateral shortage? Because people are liquidating US treasuries and and actually literally paying for the dollar because dollar is not there. So in a sense, I agree that for a long term there could be a thesis that an alternate setups in and around CNY, ruble, India, and whatnot could emerge. But that's that story for markets would begin to play out 5, 10, 20 years out.
Okay.
These are very small foundational stones that we are putting up. The Asians did that yesterday. The miracle economies, what Russia and China are trying to do. They're very small, pebbles, not even stones, so to say. It's long. I mean, for a business channel to discuss it, no. For economic channel to discuss this is absolutely, it's a great conversation to have.
Got it. Okay. So do you reckon, Maneesh, that this the dollar reg ball, as we called it, can further or will further impact the dollar rupee equation? What wouldn't surprise you? I mean, I'm just trying to get a sense. Would a sharply lower number not surprise you? What is the number on the rupee INR or the dollar INR that will surprise you? And what is a number that won't surprise you even if it surprises the market?
So Neeraj, I'm of the view that it's a win-win-win for us. That if we allow our currency to depreciate, and I have a major disagreement, and this, with the current policy thinking, and I've actually shared with them, both with government as well as RBI, that I think that we must have significantly weaker currency in a setup that we are in. In the end, we must be aware that we are running a 3.5% current account deficit, almost $125 billion. Okay, and some of it is not going to go away very soon. So you have choices. Either you do a macro adjustment, which is at vis-a-vis rest of the world, you adjust your income lower. Or you do an internal adjustment, which is, micro adjustment, which the government is, of course, trying to do with it. Okay, don't import gold duty gold because we'll increase your, impose some steel duties, do some windfall tax and stuff like that. These are minor adjustments, but in, the guy who's looking at aggregates, it won't matter much. In the end, you will have a choice, Neeraj, that either you do a 3% rate hike as you did in 2013, or you allow currency to adjust. You did not allow it to adjust for a long time in 2011, 12, and then you had a sudden adjustment. My recommendation is that let the currency weaken, because that actually would soften the blow for us. I mean, in the end, how does it matter? I'm a millionaire in dollar terms or not, who cares, frankly. So I think, when I say that it'll make a big macro adjustment, Neeraj, what it means is that, I think I've talked about it, but a car or a mobile that you import from the rest of the world, if the currency is significantly weaker, a propensity to actually consume that will go down. And what happens, of course, is that the current account adjustment has to happen through high income class, the kind of stuff that they buy, because that's the only discretionary consumption. You can't say that we import less crude, because the poor will actually suffer the most if in case you choose to do that. Or you can't say that I won't buy coking coal because it's $300 or $400 a ton. I will not buy from Australia or Indonesia. No, you can't do that, because lights will go from a poor household. But what you can do is that, Neeraj and Maneesh do not buy the next iPhone 13 or, an expensive car, which is largely imported. That channel, if you have to deal with, allows the currency to make that adjustment significantly, so that we back off a bit. That, the furniture that you're buying from China, you back off a bit and instead say that, okay, let me sort of deal with the relatively modest furniture here available in India instead of, buying, because that's too expensive.
Yeah. Yeah, well, behavioral traits of the rich certainly need to. I'm talking about Maneesh Dangi, not about me, but yeah, they need to change. But anyways, Maneesh, there was a fair degree of macro talk, and I love doing that. Now, I also want to dwell a little bit on the micro, and you had mentioned. Oh, sorry, I've forgotten. We wanted to talk briefly about crude before I move on to the micro. You mentioned that a high crude price won't surprise you, even if it kind of gets into a bit of a lull for the near 6 months. Talk a bit about that, and then we'll get onto the micro.
Yeah, so crude setup, I think is very ugly, and first time, if you're tracking what's happening with sort of Saudis and what Shell is doing in US, how insensitive the supply is to high crude prices. And to that extent, it tells you that, one, the long years of underinvestments, it's a popular narrative, of course, there's no point discussing in detail, but it has resulted in this setup in which, crude supply is not responding to higher prices. Though we all know in economics that high price is the solution to high price, but it's not happening. Now look at US, the dollar's tightness is essentially, from a US standpoint, is pointed towards, let's say, crude. It has actually decimated ferrous commodities pretty much completely.
Yeah.
But then it's unable to deal with this gorilla is because its demand supply is far too skewed. In a sense that supply is somewhat inelastic to the price point at which the world is buying. So people who think that demand destruction would take place, there's no evidence of it right now. And supply, I have no sight actually, at least in near term. Now there is a big structural story that basically before we EVize the world, we need to deal with a world which actually you and I are still driving ICE vehicles. And there is no, and the climate change policies of West and increasingly of China are not sort of supporting of building more wells and actually extracting more coal. So I'm afraid that maybe the West playbook as such could very well be that, okay, let there be higher hydrocarbon prices, and maybe for climate change, it's a good thing to do for the next generation, that we as our generation, we must make that sacrifice. But I'm saying there's a structural view that crude would sustain at higher level for a long time to come. And this has become an Achilles heel for India. India didn't prepare for this because we couldn't have done much.
Yeah, that's true. That's true. Actually, you any which of whatever were to happen, we couldn't have done much. Maneesh, so what's the impact of all of this on tradable markets? So we've spoken about the rupee. A quick question on where do you think the Indian bond markets go, and then we come to equities.
So local markets are going to be primarily, a proxy of what crude does and what CAD does, because the RBI, while it's extremely tolerant of high inflation, it again has no degrees of freedom with respect to a current account and a large BOP sort of a deficit. And also RBI as an institution has learned a lot from 2013, and which is why it's the 2013's analog is in already play, despite the very fact that we are not in a full-fledged 2013. Okay, so to that extent, I don't think we'll allow our current account deficit to slip to 4.5%, 5%. You know, at 3.5%, we are responding as if it's 4.5%. Okay, so my sense is that if crude stays here or goes higher, and my view is that a year out, when we discuss in monsoons next year, you know, crude will be higher than where it is today. I think, you know, RBI will have nothing left but to actually weigh in and actually lower the demand, especially discretionary demand, which is extremely responsive to interest rates. Okay. Unfortunately, the first reaction function will be in investment, and then later, of course, discretionary consumption. So my sense is that RBI will continue to surprise markets. You know, I mean, other markets, not bond markets, you know, who think that, you know, maybe perhaps the worst is in, and you know, bonds will not sell off too much. Then there's another narrative of, you know, India's fiscal dominance and far too much public debt. And it means that, you know, we are very likely, despite the fact that UST's, you know, cyclical peak may be in already, the Indian government bonds peak is not in yet. So that's the second point. And third, finally, there is another mess that the current account deficit, you know, Neeraj has created. You know, current account deficit essentially means a large BOP deficit, meaning a lot of dollar outflow, which results in, you know, aggregate deposits in India of the banks actually fall off relative to lending. So now you have a unique setup, Neeraj, after a very long time, that, you know, the credit is actually pretty buoyant at 12-13%.
Yeah.
Deposit is actually 8-9%. And that wedge of 4% would mean that the credit conditions and lending standards will tighten pretty dramatically over 6 to 12 months. You know, so that's another wrecking ball, you know, coming to you if you are a corporate, you know, that suddenly you're going to witness the, you know, the lot of folks who came and told you they're low for longer, you know, you're going to witness a relatively tight credit conditions, so to say, in times to come.
What does this mean for equities, Maneesh? You've been negative for a while. Are you turning at the margin, or do you believe that there is still some pain?
So Neeraj, you know, the case of, you know, creating cash, you know, of course, has gone away, you know, in a sense, because of the two pillars that it stands on, or rather three. You know, one is valuation. I think, you know, valuations are sort of at historic averages, you know, versus emerging markets, you know, we are 10-15% expensive, but relative to how expensive we have been, we are 10-15% more expensive. But, you know, that's give and take, you know, that's being too cheeky about that, no, we'll buy only 10% lower. Versus bonds, you know, I have to tell you, you know, we may not have time, but, you know, in a sense, at 7.5-8% of bond yield, what is available to you is only 2.5% and max 3% excess yield, you know, at markets level, and even lower for small caps and mid caps. So if you are dialing an equity, you know, you should assume that if you buy here, you know, you perhaps would only earn 2.5-3% more than bonds, you know. That's the valuation argument. The second argument, of course, is the flow argument, and there's a little bit of a paradox here. One is that the FII selling, the cyclical bottom may be in, okay, is for the reasons that the macro that we discussed. But structurally, you know, if we are going to discuss Neeraj in 2032, I would not be surprised if FIs actually net sold India or bought very marginal amount for the structural reasons, mostly to do with the demographics, because the retirees are going to draw down from their wealth. On the opposite spectrum, this locals cyclical peak is perhaps in, because, you know, they have a credible choice of a 8% bond yield, you know, which is a competitor to otherwise sort of, you know, for a more nuanced guy, you know, 11% yield in equity with, you know, twice the volatility or thrice in certain cases versus 8% bond, you know. So I'm saying a lot of money could actually flow to bonds. So in a sense, there's going to be flip. I think in near term, you will have FIIs actually sort of slowing, but structurally, I think that FIs will continue to be sellers. And locals will continue to be buyers structurally, but the cyclical peak of their money coming in are actually in. So again, you know, you have to, you know, broadly, if I sort of, when we discuss finally the big picture markets, you know, people like me who like to buy good macro and liquidated markets, you know, we're not yet in. But people who are in the business of being market is your audience, you know, you ought to be a little contra. The net returns available to you over long periods of time is going to be very low, okay? But then you're going to have far too much, volatility over next 3, 6 months, 12 months, and you will see these euphoric conditions as well as very pessimistic conditions, and play contra instead of momentum, which has been a key, feature of last 20, 25 years of markets. For novices, of course, I mean, SIPs you must continue, but if you could be overweight at margin, money should be deployed in bonds instead of equities. Is how I think of markets.
So you're not turning your opinion per se right now. Large money, bond versus equities. Within equities, maybe for not an expert, the SIP route stays, but for an expert, there might still be better times to put in money, even if the person doesn't sit on cash. Selling
and
and
if
sitting
you're
on
a
cash.
regular guy, you have nothing else to do but stare at the screen, at least be contra and don't buy into this narrative that India's golden age is ahead for us. No, it's not. We actually face extraordinarily ugly exteriors, which our generation hasn't seen. A disintegrating world order, troubled geography with two-front war, energy scarcity, and extreme weather and soil erosion and persistent inflation. So, and along with that, at this move of China plus actually resulting in reshoring, where there is a bit of a boom going on in North America in terms of capex, putting a lot of pressure on wages there, and which basically means that a relatively longish cycle of tight dollar. So all of these are structurally very bad for markets if you were thinking of 3, 5, 10 years out. Okay, but in this 3, 5, 10 years, as long as you don't buy into this narrative that buy and forget, instead you buy into my narrative that on liquidation buy, and if macro turns worse, get out and make that money, and as and when bonds give you reasonable opportunity, hide there. I think that's a better strategy, Neeraj, than the alternate that just forget, buy into equities and don't even bother. That's for an active guy. I mean, 3% more or 2.5% more, given the tax, efficiency of equity. Is it all right? Yes, and which is why SIP for an average investor should continue.
Maneesh, my final question, really. I know you don't look at. We obviously don't talk about, individual ideas, things, etc. But I'm just trying to understand. Where are you on this argument of either value versus growth, or for that matter, a tech world dominated by tech versus non-tech, but still the demand being very strong because the world is going digital? There's a lot of argument around how Indian IT could do now versus what it could do. There's a lot of argument about how companies with futuristic earnings have gone down but will continue to go down further, versus some people believing that the bottom is in place. Where are you on these arguments?
So, my point to you has been in the past that I've sort of relayed maybe privately that, the bottom is in for the hyper growth, I think, and to that extent, if something, is hyper growth is, where the real earnings are going to come in distant futures, perhaps, but it's high tech and, there's a reasonable fidelity to the argument of their earnings. I think, that's a neat stuff to buy. Okay. So I think, if NASDAQ is a proxy of growth, it's done a fair bit of correction, and it's actually telling you narrative that, economy is in recession with certainty. So if you're dialing risk incrementally, growth, and let's say NASDAQ or Indian IT, despite the very fact that they're going to be in near-term margin pressures, okay, that if you can, I'm assuming that you're asking for an audience who could actually look through all of this, I think a reversal of the very popular trade that's 12 months back, 8 months back, we discussed that, the commodities secular bull market, okay, was then. I think what's likely to happen is, I think on commodities, you will be surprised in 2-3 years' time that they are sturdier than what many people give it credit for. I'm actually reversing that call, where I argued, I remember, with you many times, that commodity bull market is a wrong bogey to go after. The non-ferrous commodities at margin are actually starting to look reasonable if you look 3 years out, and through firms you can do that. Of course, you can't buy commodity because that tends to be too volatile. Similarly, hyper growth, the bottom is in because far too much of excess which was baked in there has been flushed out. That's not been flushed out from Nifty and even small cap, mid cap. Okay, but if you are a bottom 50% of Nasdaq, it's been flushed out. In local IT is also to a certain extent it's been flushed out. So even that trade actually you can pile on today. I think at margin, my basic instinct for a regular guy is to do reverse of what the popular narrative is, at least in these times. Okay, in these times, because we are not going to have a directional secular bull market where the force which is out there in markets will pull all the boats. It's not going to happen. So basically, it's all about rotation and rotation and rotation. So,
right, but you're not rotating into mid caps and small caps. You're still staying away.
No, because there is no flash. There's far too much of naive money in India. Which got into this with assumption in exotic firms and sectors with an assumption that it's a pivot to doubling, tripling money every 3-4 years. Their what do you call moment of truth is yet to arrive. I mean, but if you are an upstart buyer or an in-mode buyer or ARC buyer, the moment of truth is already in. You've fallen by 80% and you've lost your capital, and so to that extent, the flush has already happened out there in US, not in India.
Got it. Maneesh, splendid talking to you. Thank you. I took more than the prescribed 20 minutes, so excuse me for that. We almost went double that time limit, but it was lovely talking to you today.
Time lapses, when you talk to a good guy. So you are a good guy here.
I second that. Anyways, but thank you so much for talking today.
Good talking to you.
Lovely talking to you, viewers. Thanks for tuning into this leg of BQ Conversations.